From the morning reading, small cap IWM rises as downward momentum slows in the spider and Qs following the jobs report. Facebook bounces, airlines take off, steel stocks rise. 4 of 10 sectors moved higher on Friday. XLV, XLRE, and XLB were the strongest sectors, while XLP was the weakest sector. Oil futures dropped 54 cents to close at 44.13, its lowest close since September 19th. On the S&P 500 snapshot, the first 9-day sell-off in nearly 36 years. The S&P 500 posted another modest loss, extending its current sell-off to 9 sessions. The last 9-session sell-off ended December 11, 1980, about 5 weeks shy of 36 years ago. The index opened at its intraday low and whipsawed with indecision in the first 15 minutes of trading despite a good October employment report. It then traced a fairly symmetrical arc through the rest of the session with a midday peak gain of 0.50%. The afternoon saw an accelerating decline to its negative 0.17% close. The current 9-session loss is now at negative 3.07%. Now for some context. The 9-day sell-off in 1980 was far more dramatic at a minus 9.37%. And consider this, we've had 13 9-session sequences ending in 2016 with a cumulative decline of more than negative 3.07%. In fact, the single daily decline in 2016 was negative 3.59% on June the 24th. The 10-year note closed the session at 1.79%, down 3 basis points from the previous close. More bets against the VIX. Volume and put options on the VIX soared to a new all-time high on Friday. Previous jumps in put volume had coincided with a peak in the VIX, but this time is a bit different in that the overall open interest is still low. Even so, there is solid evidence that the fear gauge should peak by Wednesday. Stocks have declined for 9 days. This streak of down days is already getting overhyped and not worth spending much more time on. We showed a thumbnail chart of all 12 of the other times the S&P dropped for 9 straight days, mostly leading to bounces. Hello, this is Stephen Harris, a head trader from Falcon Global, where we model best practices for investors, traders, and day traders from entry to exit every trading day. In this daily video, I'll provide my opinion and insights of current market trends, market timing, volatility, and hedge risk levels for the upcoming day for the key U.S. financial markets. It is 6:04 a.m. Mountain Time, and I'm recording this in preparation for the market day of November the 7th, 2016. Full disclaimers are at the end of the video, but be aware that this is for educational purposes only, and only you are responsible for the investing or trading decisions that you make. Okay, let's go ahead and jump into the morning report. And at the time of this cut, we're up big on all 4 of the U.S. broad-based indices. The S&P futures were up some 27 points, up about 1.30%. Russell futures were also up big, closing in on 2%, and NASDAQ also up 1.46%, and the Dow up about 1.25%. Crude oil's also up big, 1.4%. Euros down about 0.4%. Bonds are down about 0.25%. Interesting that bonds are down so little when the equities are up so large. Gold down big, down about 1.2%. In overseas action, everybody was open in the markets that we follow. China up about 0.25%. Hong Kong up about 0.7%. Japan up about 1.6%. Germany up about 1.6%. And the United Kingdom up about 1.4%. So it would seem that the U.S. and Europe are all up very large. In terms of the macroeconomic reports for today of note for the United States, I don't see anything. We've got some yellow flag reports, nothing expected to be market movers. And looking forward to tomorrow, we have JOLTS job openings, mortgage delinquencies, of course the election, and that's it. So let's go ahead and take a look at current volatility conditions. Short-term VIX closing in on a 30. It was at a 28.82. Skew also elevated at a 133, though not quite as high as it was in the prior session. IV percentiles are closing towards the upper limits on the S&P at a 72. The others are more kind of middle to upper. Russell 55, NASDAQ 55, and Dow at a 65. So definitely raising the numbers here compared to where we've been most of the time in recent weeks. Still no close-to-close standard deviation size moves on any of the four broad-based indices, so we continue to be relatively small. Okay, let's go ahead and go to the charts. And here's our S&P, and you can see the big overnight jump. It opened way up and then built slightly on that. So this was not a case where it opened and then just kind of climbed throughout the overnight. It gapped way up and then it's pretty much been stable since then. So I'm not sure just exactly what the news was that made this big gap, but it would seem that it came into play prior to the Sunday afternoon open. And on the Dow, you see the same picture. Now, even though this sounds like a huge gap, it just brings us back into the trading range that we were in prior. So we'll have to see if we build on this or not. But this is the kind of volatility that we were expecting as we closed into the election day. And of course, volatility can go both directions. We talked about how the market makers were pricing in quite a bit of volatility around the election, and you see the same pattern on all four of the indices. In terms of our other markets that we follow, crude oil did not experience the same kind of gap, though it is up off of Friday's lows. Gold has dropped. So if there was any risk, fear kind of safe haven status working for gold, it would seem to have backed off. And it also backed off of that key resistance area that we've been talking about of late. We've had several days, several sessions here where it kind of bounced around the resistance area and now has backed off. And bonds have been in a sideways consolidation, and interesting enough, even though the other markets have moved fairly significantly on Sunday night's session, bonds have not. And let's see if something happened with the dollar. The dollar did move fairly significantly, gapped, and then continued to build. So a little different pattern than what the equities did. And then volatility, and we see volatility is dropped quite a bit from Friday, though it has remained pretty much in the same place since then. So we'll continue to see what happens when all the cash market participants come back into play. But right now, we have what we call a professional gap, where the institutions and others that trade in the overnight sessions have led us into a very large gap, and we'll have to wait and see the cash participants come in as to whether they build on that or they fade that. Okay, let's see here. Let's go ahead and go to the daily report. And this daily report continues to look very, very ugly. Now, this, of course, does not include anything that happened in the Sunday night session. And indeed, for the most part, this is built on the intermediate term time frame. It is not going to change, a lot based on what happens in, a few hours kind of thing. The intermediate term phase opinion, still market phase 5, the break of diagonal and horizontal support, and that's referring to the S&P there. In terms of the 3 market timing signals, still very, very ugly here. Uptrend under pressure, the first one from IBD. The second one, the GMI index, is a 1 out of 6 with a sell signal in place since 10-12. The third mechanical signal comes to us from Stock Trust Decision Point Scoreboard, and the short term is on all 4 neutral to bearish. The intermediate term neutral to bearish in 3 out of the 4, with the Nasdaq still holding up with a bull signal against long-term signals on all 4 of mixed. So overall consensus still remains a neutral to bearish consensus. In terms of the position sizing models, the first one's at 50%, the second one also at 50%. Intermediate term market posture is about as ugly as it can get. Severely strong bear signals on the S&P, the Dow, the Nasdaq, and the Russell, all 4 now in the severely strong bear camp. These are reinforced with a weak bear sentiment line, so down moves are expected to be the more pronounced moves, and bull moves are expected to be shorter at this point. The strength of the trend is a weak trend. You see we've fallen well below the 80 signal line, and historically when we have fallen below that 80 line and not immediately recovered, and you see a case here, an event here, an event here, generally these are the kinds of events that are related to sequestration or something like that, where there's just kind of a binary event and then everything corrects as soon as that news is resolved. But in the past, when we have fallen below 80 and not immediately corrected, we've usually had a more significant kind of correction in the market, and it would seem that we are signaling that at this time. Hedge warning status remains level 3, which is our crash warning. This is not a prediction of a crash. It is a statement or opinion that the conditions are present for a crash to happen. And crash, of course, looking at something of multiple percentage points and drop. Now, right now, we're down about 3%, which is, a pullback. Pullbacks are less than 5%, but certainly nothing of, significant impact as at this point. So if indeed these conditions are to follow through, it would seem to call for a significantly greater weakness. Now, this is all up against new information coming into the market, and that could very well be the election. As the election results come in tomorrow night and much is resolved, we could see that depending on where that election goes with the president, the House, and the Senate, that the market responds and reacts to that. And it could go either way depending on where those election results come in. In terms of where we are in terms of the 3 strategy opinions right now, the first one, option income strategies, the VIX is outside the acceptable range to initiate new positions for novice traders. And of course, you're also at hedge risk level 3. So that would call for significant caution, even if you're an aggressive trader. Cover call strategies and put selling both are, and conditions are not acceptable to initiate new positions for novice traders, as you would expect with being level 3. So even for aggressive traders, I saw one of the authors that I follow has actually gone to cash on his covered call strategies. So that should give you a bit of a wake-up call if you've not already got there, that things should be very, very close to the vest. Not just in the initiation, but perhaps consideration of the current positions that you have on. When you look at the specific warning section, it's about a sea of red. Just about everything that can be in warning status is in warning status. All the volatility-based stuff is basically in warning status, to save one that could be in this kind of warning. You see the distribution day counts. You see the 10-day expected move is now above an 80. So last night we moved about 30. You can see what can happen when volatility is priced in, and that is then realized. Things can move in a very large hurry. In terms of the trend-based warnings, all three are still firing. You see the New York Stock Exchange new highs, new lows indicator well over the 300 threshold for Friday. The intermarket risk aversion indicators, all five, still solidly risk off. In terms of sentiment, the fear and greed index is in extreme fear at a 14. And that's about as low as it has been of late. In terms of sector specific, you see that real estate, healthcare, materials, and industrials were able to pull out positive days on Friday, but overall quite a bit of red here in the other sectors, both in terms of sector performance as well as breadth. And indeed, in terms of looking at market posture across all three time frames, with the exception of transportation, which is bullish in all three of the market posture time frames, and we've got pretty much a sea of red everywhere else. And indeed, in the multiple time frame analysis, 1 day, 5 day, 1 month, 3 month, quite a bit of red here, and no consistency. No sector has been able to hold up across all of this of late. Now, this could change with today. If we end up still at the end of the day up some 30 points, you could see some of these start to pop green on the more recent action. In terms of the relative rotation graph, this has been a big swirl of lately and not a lot of consistency in terms of anything kind of just building and going into the stronger area. IYT is perhaps the best example of that, and that's transportation. We noticed that one up here as well as being in the three different market posture time frames performing well. Well, it certainly is popping up down here in the relative rotation graph as well. Others still holding up in the upper area. KRE, that's your regional banks. FDN, that's your internet index. And XSD, your semiconductors. They're still in the upper area, though they have been weakening somewhat compared to where they were. So kind of keep all that in mind. That should be enough for today. So we'll go ahead and roll this together. One of the things, if you've not already done it, certainly there is an opportunity to follow us on social media, and I particularly would point you to Twitter. I follow some 150 plus financial services on the Twitter feed, and then forward what I feel are the most interesting, retweet those to the followers. So that might be something of use to you. And then, of course, there is YouTube. And on YouTube, you have the opportunity, and here's the regular hyperlink to go to our channel page. You can subscribe to that channel page, and there's no cost to subscribing to that channel page. But what it does do for you is it alerts you to when new content has been posted. There's also, from the YouTube channel page, of course, these tools that can be used. And one of those tools is to make sure that you are following this in high definition resolution, especially once I get past the morning reading and I start flipping through the charts and so forth. It's much better to be watching it in high def. So make sure you see that gear button has an HD on it. If not, click on that. Make sure you change the resolution to get the best feedback. You can also go to full screen, click on this button here. And then the next thing I would point to is that on the playback, you can go to a 1.5x, so that plays it at about 1.5 times the speed in which I recorded. And I think you'll find that once you got used to the routine and pattern and how we review the market condition each day here, that you can follow this on a sped up kind of version and be able to comprehend and get the information that you're looking for, and then cut some time out in your morning routine. So something to think about there as well. So some tools available through the use of the YouTube channel, which is part of the reason we post there. And then I'm going to flip through these slides here. If you see something of interest, just hit the pause button, go to that hyperlink, and that'll get you additional information. And then, of course, always the disclaimers. Hit the pause button if you need more time to review the disclaimers, and then also note the hyperlink down here at the bottom for the full set of disclosures. We'll be back here for our next session on Election Day. Though obviously the election day itself, while there'll be some exit polls and so forth, nothing's really going to mean anything until well after the markets close. So it will be tomorrow night going into Wednesday morning that you'll see the real market response to real election results. So kind of keep that in mind. And there's a very big opportunity for significant volatility in this week. So keep that in mind as well. Certainly, it's all about managing risk. We talk about managing risk all the time here. And if you do that, you'll see your consistency start to come together. In the meantime, go out there and look to learn something each and every day, and good trading to you.